So, Namaste, Vanakkam to all of you. Please confirm that we are on to the class. Just want to just check up as whether you are in a position to hear me. Today also we had some problems at the very initial stage and got it rectified. Please confirm. Okay. So now let me just start. Say yesterday towards the end, we were discussing something on learning curve. One of our friends from Erode was just telling, he's Tirumalai. He was just telling that I went a little fast and all that. So let me just tell you that there is always a difference between a regular class and a crash course. What I did for taxation was different. The subject was different. See, as far as fasting is concerned, it is entirely different. See, here computation is very much involved. I expected you people to come prepared, a little prepared for what is learning curve and all that. Anyway, I will take up that briefly for 10 minutes as what exactly had happened. Okay. Now we will start. So kindly recall the discussion we were making in the last few minutes of the last class. That was with respect to learning curve. The problem did state that there was some towards the end of the life of this product, they were not in a position to fix what is the price. So the problem did had life cycle costing, application of learning curve, and price fixation. There were three items that we had in that particular problem, which was there in the institute study material. And total product, I'm just redoing for 10 minutes on to that last problem that we did in the last class, question number 10. So 5,000 units was the total number of units as far as that particular product can be sold. It is something like Nokia, which I was just referring about. Up to 4,500 it was prospective, last 500 it is on the declining phase. So during the declining phase, they can't be selling out at the normal prices. And as we do the job repeatedly, we would just find that average time for every double count of the production, there will be a consistent fall in the labor usage per unit. So because familiarity and the efficiency setting in, learning curve will reduce the overall time. So they have mentioned this way. I will put it like this way. So totally it is from 0 to 5,000 up to a stage 2,400. There was a consistent fall in the average time consumption per unit. Okay, from whatever they will, there is 24 batches if there was consistent fall. Okay, so whatever time that they were experiencing in the 25th batch, that is the time that they would be consuming for the remaining period. So totally, if you take up one batch as 100 units, for 5,000 units, we require 50 batches. In 50 batches, 24 batches, you had learning curve effects. Learning curve effects. 25th batch also you had. 24, up to that you had. 25th also you had. But what you had for 25th batch, this is 25th batch. This is what you find for rest of the period will be the constant ratio, or you can say that there will be no further learning curve effect you would be finding. So up to 24 you had, and whatever you have experienced, that will follow. So therefore, total 50 batches we can put it into 24 batch and 26 batch. This is what I have done in the computation. 24 batches for which this is the average time, 6 rupees is the cost, and 242 is the time taken for the 25th batch. That we have computed like this way. That 242 into 26 batches into 6, this is the labor cost. Then fixed overhead they are given, targeted profit also they are given. Then other material cost 19 rupees they are given. If you total up all that, it will come to the total sale value of the entire product during its lifetime. And for 4,500, what is the selling price? and how much is the sale value they given. So naturally, the difference is going to be the sale value for the last 500 units, and the 33.01 is what we got, 16,506 divided by the last 500 units. So firstly, I was just under the impression that this 80,000 is the profit only for the last 500. Only at a later point of time, I have understood and made that correction in the presentation, and we got 33 rupees and 1 paisa. In Institute Study Material, the same problem is worked out. They have worked out as 32 and 98, 32.9. 3 rupees difference only, and that is on account of this computation, where we have just went on for accurate way of computation. I hope that you should be in a position to understand this with Institute Study Material as well as our explanation. Okay, so I could just spend some amount of time. I agree that in a crash course we may have to go a little fast only, but when you are taking up the examination and when you are at lockdown, you should be spending extra bit of time and come prepared. You know that it is going to be costing would be, so you come prepared. Log table and all that, I was just spending time as how to find out log table and the log and all that. So students of CA are coming from different levels. One would have cleared intermediate just last batch. Other one would have cleared one group long time back. Some of them will be in close touch, some of them will be having remote touch of the subjects. And CA class will always be heterogeneous crowd, not homogeneous crowd. So teaching homogeneous class will be very easy. And it is very challenging to take up CA class, and that too online without seeing the face of the students. So therefore, what we are just doing is the most challenging job, but yet with all this, this should not be the reason for non-performing. So despite all the difficulty, we should be clear. That is what it is all the spirit. Now today we will be taking up on to decision making and relevant question. I told you that you should come prepared for question number 2. You will not be finding it in any textbook. I mean, Institute Study Material. Let us just go through that. Question number 2. Pleasant Industries manufactures pharmaceutical products in 2 departments, mixing and tablet making. Additional information on the 2 departments department is as follows. Each tablet contains 0.5 gram of direct material. Mixing and tablet making. Capacity per hour 150 and 200. Capacity 2000 hours available in each mixing and tablet making. 3 lakh grams and 4 lakh tablets. So we understand monthly production is 2 lakh grams and 3,90,000 tablets. Fixed operating excluding direct material 16,000 and 39,000. And per tablet they have just mentioned as how they are getting 8 paisa and 10 paisa. Mixing department makes 2 lakh grams of direct material mixture enough to make 4 lakh tablets. Because tablet making has only enough capacity to process 4 lakh tablets, all direct material are incurred in mixing department. Pleasant incurs 1,26,000 in direct material cost. The tablet making department manufactures only 3,90,000 tablets from 2 lakh grams of mixture process. 2.5% of the direct material mixture is lost in the tablet making process. Each tablet sells for ₹1. All costs other than direct material are fixed. So please understand that when you find except direct material all are fixed, then you are living in a different chapter that we call it out as throughput costing. THROUGH, throughput, TUT put costing. It is there both for old and the new. So then what is that we should take up? Very simple, labor will not be a variable cost, and there will be only one item which will be representing variable cost, that is direct material, rest of which will be taken up as fixed cost, and the rest of the matter like finding out contribution, breakdown point will remain the same. Instead of calling it out as contribution, we will call that as throughput contribution. So in a crash course, it is enough to learn only to this extent, rest of which you can try off your own. The following requirements refer only to the preceding data. There is no connection between the requirements. First one, an outside contractor makes the following offer. If Pleasant will supply the contractor with 10,000 grams of mixture, the contractor will manufacture 19,500 tablets for Pleasant, allowing for 2.5% loss during tablet making at 12 paisa per tablet. Should Pleasant accept the contractor's offer? Show your calculation. Then item number 2, another firm offers to prepare 20,000 grams of mixture a month from direct material. Pleasant supplies. The company direct material, Pleasant supplies. The company will charge 7 paisa per gram of mixture. Should Pleasant accept the company's offer? Show your calculation. Pleasant's engineer have devised one minute. Pleasant engineers have devised a method that would improve quality in the tablet making operation. They estimate that 10,000 tablets currently being lost would be saved. The modification would cost 7,000 a month. Should Pleasant implement the new method? Show your calculation. Suppose that Pleasant also loses 10,000 grams of mixture in its mixing operation. These losses can be reduced to zero if the company is willing to spend 9,000 per month in quality improvement methods. Should Pleasant adopt the quality improvement method? Show your calculation. What are the benefits of improving quality to the mixing operation compared with the benefits of improving quality at the tablet making operation? The last part I would like you people to try. It is of a theory in nature. So now let us just take up the first one. Now let us just take up question number 2. Let me tell you that there are 2 departments. One is mixing department, the other one is tablet making department. Right? It is all something like your mom would be just doing all that. So one mixing will be happening, then production will be there in the form of food item. So now let us just take up this, the first part of the question. And prior to that, let me just look into the data and convey to you as what is the bottleneck there. So when you have more capacity in mixing, you find the maximum capacity is 3 lakh grams. So half a gram is required for 1 tablet. That means why they are not in a position to fully utilize the capacity for mixing is that the tablet department, the tablet making department is the finished product department which has got a capacity to the extent of only 4 lakhs. That means 4 lakhs tablet only they can make. Each tablet will be of 0.5 gram. That means only to the extent of 2 lakh grams they can take it up. So because of the fact that tablet making can take inside for their production only to the extent of 2 lakh grams, mixing department is reducing their production to 2 lakhs. So you find the company did not plan well as what should be the production, maximum production they should set. They should have set the production in such a fashion that either they should have brought the capacity of mixing to only 2 lakhs or they could have increased the capacity of tablet making to 6 lakhs depending upon the demand they should have done. That planning is not done, and this is what we discussed in theory of constraints. So we have topic both in old syllabus and new syllabus, theory of constraints. we talk only about the constraints that the organization had created in them. So now this is the brief matter which we could just discuss, and there is only one variable cost that they are incurring, that is incurred in mixing department. The direct material cost is 1,56,000. This is what we understand. And in the process of making tablet, there is 2.5% loss that you have. This is the brief background. Now, an outside contractor makes the following offer. If Pleasant will supply the contractor 10,000 grams of mixture, the contractor will manufacture 19,500 tablet for Pleasant, and the rate is 12 paisa per tablet. Should Pleasant accept the contractor's offer? Is the question. See, some of our friends are asking the question from where I get the problem. Past Bhatta is asking a question from where we get questions. So I would only tell that you should have registered before. The problem is that the person who is coming in between is asking for question is going to there is cost problem for me. So you have to send your request in WhatsApp. So this is what you find, sheer indiscipline only. So whenever you go to a place, definitely you need to know as you have to take up material, calculator, etc. So you have to send your WhatsApp, and the moment I find in WhatsApp your registration, I will forward it to you. Okay. Then now let us just understand that the selling price per tablet is given in the problem as ₹1. Then what is the variable cost? Variable cost per tablet is going to be 1,56,000 we have incurred in the previous process, and that should be divided by 3,90,000 tablets that is being produced. Even though you produce only 4 lakh tablets, but saleable product has come to 3,90,000. So cost is to be recorded only by good units. Now let us just take up the calculator and work out as what is the variable cost per unit. So how much is that? It comes to it comes to 40 paisa. So contribution per tab is 60 paisa. Correct? Now you find the problem is that the capacity is the problem. Contribution is 60 paisa. You find capacity is a constraint. Whose capacity is a constraint? Even though mixing department can produce to the extent of 3 lakh grams, but they are producing only 2 lakh grams because tablet department can take production only to the extent of 4 lakhs. So now some other contractor is saying that he can take up 10,000 grams of mixture, and with that he can produce, that is one tablet is 0.5 gram. He is expected to produce 20,000, where you give 2.5% normal loss, and with that 19,500 additional units you could produce. So the end user, the customer may not be knowing whether it was produced by the company itself or subcontractor. So we understand that variable cost, that is additional cost per tablet, is going to be 12 paisa. Because he says tablets are 12 paisa per tablet. Whether we can accept it? Answer to the question is yes, we should accept it. So we get net benefit to the extent of 0.48 and the number of units 19,500. Net benefit is 0.48 multiplied by 19,500. So it gives a benefit of 9,360. Is that right? It gives you a benefit of 9,360. Okay. This is first part of the question. Are you clear? Then, second part of the question. What is the second part of the question? Another firm offers to prepare 20,000 grams of mixture a month for direct material from direct material plus and supplies. The company will charge 7 paisa per gram of mixture. Should Pleasant accept the company's offer? Show your calculation. So please just understand, tablet making department is having bottleneck. What do you mean by bottleneck? It has got a maximum capacity of 4 lakh tablets or 2 lakh grams it can take. Okay. See, as far as the new contractor is concerned, he is not helping to prepare. I am answering to the second part of the question. Please understand. For the second part of the question, 20,000 grams. Additionally, you can try. Additionally, can be tried. But where this 20,000 grams will be transferred, this 20,000 grams is going to be 40,000 tablets. Where is that you would be taking up? Only do tablet making, where tablet making is operating at full capacity. So there is no meaning in increasing the import without having scope for processing it as finished goods. So therefore, we should only tell it that mixing department, what is that? Mixing department is not a bottleneck. Is not a bottleneck. Increasing production by mixing will not be benefiting. We don't have to just even compute and tell. In the last case, that particular department was the key department. Based on the capacity of tablet making only, production of mixing department was decided. Okay. So reject the offer. No computation is required. No computation is required. Third question. What is the third question? Pleasant engineers have devised a method that would improve quality in tablet making operation. They estimate that 10,000 tablets currently being lost would be saved. The modification would cost 7,000 a month. Now you have got to tell whether it is beneficial or not beneficial. You have got to tell very clearly. Okay. So now let me just repeat. Pleasant engineers have devised a method that would improve quality in the tablet making operation. That is, they have not improved the quality of the product, quality of the operations. That resulted in that rejection of 2.5% is eliminated. So you find 10,000 additional units you would be getting. Now, I would like you people to tell us what would be the answer for this. I will just give you 2 minutes time. That is the reason as why I have told you, please come prepared with this. Now you have got the answer for the third part of the question. Please answer, I will wait. Pravina, all others, please just take up on to this particular question, question number 2. Under that sub question number 3, I want all of you to participate. Get me the answer, please. Come on. Because your response, your participation is very important in proceeding for the next stage also. So even if it is costing 2 minutes, okay, we will just spend that 2 minutes and proceed. Come on. Even you can try it through WhatsApp, no problem. Balachandran, 10,000 minus 7,000 equal to 3,000 increase in profit is what our friend is just studying. How about others? Say whether it is right or wrong, I will communicate a little later. So contribution is 6,000, additional cost is 7,000, and therefore it is negative 1,000 is what another student was just communicating. So now 2 answers they have provided. Now I would just say the first answer is correct. You should accept. So what is that we will take up? So we find that 10,000 additional units you are in a position to sell at ₹1. So 10,000 is the benefit that you derive. There is no variable cost that you are incurring. Why there is no variable cost that you are incurring? That material cost of 1,56,000 we have incurred for 2 lakh grams that resulted in 3,90,000 tablets previously. Now for these 10,000 tablets that you are making additionally because of improving the quality of the operations, there is no additional expenditure that we have incurred on variable cost basis, and therefore the entire sale value becomes our benefit, and the cost that we would be incurring for improving the quality, that being the cost 7,000, and we are having a net benefit of 3,000, and there is no variable cost that we have incurred. So therefore, don't multiply this 10,000 with any variable cost of 4 paisa or 60 paisa, whatever we have just computed. So please just understand that variable cost of 40 paisa or the contribution of 60 paisa cannot be used in this particular case, because this 10,000 additional units for which there is no variable cost at all. You are improving the quality of the operations, not by spending per unit basis, but you are spending on a fixed cost basis, that being 7,000. And therefore, you are expected to compare the sale value of the 10,000 with 7,000 rupees cost of improving the quality of the operations, and thereby you are benefited by 3,000 and you are expected to accept this offer. So what Balachandran had just communicated is correct. Then next item, fourth question. Suppose that Pleasant also loses 10,000 grams of mixture in its mixing operation. So which is not there in the original problem, but they are creating. That is why I told that very clearly that each case is an individual case. Suppose that Pleasant also loses 10,000 grams of mixture in its mixing operation. These losses can be reduced to zero if the company is willing to spend 9,000 per month in quality improvement methods. Should Pleasant adopt the quality improvement method? Show your calculation. Here also I will just give you 2 minutes time, make it fast. Answer to the fourth part of the question. And with that, fifth question I am giving it to you. That theory portion you please just try. Okay, please just try for the fourth part of the question. Come on. Please answer for the fourth part of the question. So answer for this part of the question, rest of which I would give, or I will be focusing more on to relevant costing today. Come on. You can answer through WhatsApp or you can put it through this chat. Please answer to that question. Nobody had answered, please make it fast. People are taking more time. Real-time response is not possible. But at least one should be in a position to do it, no? Okay. So he is also right in a way. Real-time response is not possible because we are lagging behind, is what he is just telling. Anyway, I will continue to try. So question number 4, for which I will put it like this way: 10,000 grams is losing. So cost of or what you can call it out as a cost, which is going to be 1,56,000 we are incurring for direct material. divided by 2 lakhs grants multiplied by 10,000. That comes to 7,000. Yes, 7,800 cost saved. So far you are incurring this much of loss. Now you are having cost saving to the extent of 7,800. Now what is the cost incurred? Cost incurred is 9,000 and net loss to the extent of 1,200 and reject the offer. Reject the offer. So fifth question, you please just try. Now, no questions I will be asking. I will be just going on repeating it 2 times a particular item. In case you are not following, just don't stop me from proceeding. The same video is available. You can definitely hear it once again or as many times as possible. So no problem at all. Now we will take up on to question number 3. Question number 3, a research project which to date has cost the company $150,000 is under review. It is anticipated that should the project be allowed to proceed, it will be completed in approximately 1 year when the results would be sold to a government agency for rupees 3 lakhs. Shown below are the additional expenses which the managing director estimates will be necessary to complete the work. Material 60,000. This material which has just been received is extremely toxic and if not used on the project would have to be disposed of by special means at a cost of rupees 5,000. Labor 40,000. The men are highly skilled and very difficult to recruit. They were transferred to the project from a production department and at a recent board meeting, the works director claimed that if the men were returned to him, he would earn the company each year $150,000 extra sales. The accountant calculated that the prime cost of those sales would be 1 lakh. When the overhead absorbed, all fixed would be amounting to rupees 20,000, research staff 60,000. Their decision has already been taken that this will be the last major piece of research undertaken, and consequently, when work on the project ceases, the staff involved will be made redundant. Redundancy and severance pay have been estimated at 25,000. Share of general building services 33,000. The managing director is not very sure what is included in these expenses. He knows, however, that the account staff charges similar amounts every year to each department required. Assuming the estimates are accurate, advise the managing director whether the project should be allowed to proceed. You must carefully and clearly explain the reason for your treatment for each expense item. Now let us just try this problem. Question number 3. This is the second day. So now let us understand that there are only 2 alternatives available before us. That is, it is a research project where we can continue this or we can drop it. There are 2 things only you have. Either you continue or drop it. So if I continue for 1 more year, it will cost, there are 2 things that you have in the first paragraph. Let me take up paragraph by paragraph. A research project which to date at cost the company $150,000 is under review. It is anticipated that when the project is allowed to proceed, it will be completed in approximately 1 year when the results will be sold to a government agency for rupees 3 lakhs. See, if I continue to, I am talking about $150,000. If I continue with the project, my past cost will continue to be $150,000, and when I drop the project, the past cost of the research will continue to be $150,000. So when you find our cost is remaining unaltered, what is it? Cost remaining unaltered for various alternatives. Cost cost remaining unaltered for various alternatives shall hardly influences decision making. Hardly influences means never influencing decision making. That is, my cost is remaining unaltered. So such costs are ignored for decision making. Okay, they are referred to as sunk cost. They are referred to as sunk cost. So we should ignore it. So ignore. This is the working notes that we will be developing. Working note number 1. So for ₹1,50,000 rupees, whether I continue or abandon, that ₹1,50,000 what we have incurred will continue to be the same number, and therefore we will ignore it. The first statement. Then working note number 2. Similarly, when I continue, when I drop. So that is for research cost. This one is revenue. See, if I continue, I will get 3 lakhs of rupees. If I do not continue, I will not get any amount. So when the figures are different for these two alternatives, naturally this becomes a relevant item for consideration. So what is that thing we should be doing? It is a relevant item. It is a relevant item. So that being revenue. Revenue of 3 lakhs. That's it. Every item you put it like this way, decision tree. You try, one is continuing, other one is dropping, and put the numbers, find out whether they are changing or remaining the same. When they are remaining the same, ignore. When they are changing, take the change and consider that as relevant cost or relevant, call it out as a relevant income or relevant expenditure. You may call it as opportunity gain or opportunity cost. Next question. Material 60,000. This material which has been just received is extremely toxic, and if not used on the project would have to be disposed of by special means at a cost of rupees 5,000. So as far as this material is concerned, if I continue and if I drop, so please just understand the cost can be divided into two. There are two things that you have: purchase cost, disposal cost. There are two costs that they have referred. If I continue with that, I got to pay 60,000. When I am continuing the project, I will take up the material. Our disposal cost will be nil. If I drop this, then also it will be 60,000. How do you know that it will continue to be 60,000? Look into the wording. The material which has just been received. That means you have purchased it. You have made a commitment and got it. So you are committed for this. And if I drop this, I will be incurring not only this 60,000 but also this disposal cost of 5,000. So therefore, whether I should consider this as opportunity cost or opportunity gain. So please just understand as how you are projecting. How you are projecting. Projecting is that whether to take up the project or not. So normally we have to consider only on a positive note. If I take, these are the costs. Similarly, if I take this to the extent of 5,000, I will not be incurring. So when you are asked to find out as whether the project should be taken up or not, we normally start our discussion saying that we will take up the project and what would be our income and what could be our expenditure. When we take up the project, this 5,000 rupees we don't have to incur at all. So therefore, it is going to be considered as opportunity gain. What is that? Opportunity gain. So expenses avoided or cost avoided is an opportunity gain. So in income side, it should be taken as 5,000. When you are putting it out as cost, this should be shown within brackets 5,000. How it is to be disposed of? Take as income or else as negative cost. Please be careful, don't get confused. It is income, it is to be taken up as income or else take it up as negative cost. Between the two, you have to do. But if you put it out as 5,000 without brackets, then you are indicating that you are spending 5,000 because of continuing. You are avoiding 5,000 rupees. So please be careful. Please be careful. Don't say that I am fast. You should only be reviewing it. Is that clear? Next. Material is over. Then working note number 4. This is for labor. Continue and drop. So you have something called as sales, prime cost. In prime cost, they say material, labor, and all that will be included. And you will have contribution and all that. By going through the problem, we understand. Labor is 40,000. The men are highly skilled and are very difficult to recruit. They were transferred to the project from a production department. And at a recent board meeting, the works director claimed that if men were returned to him, he could earn the company ₹150,000 extra sale. So when you drop this research project, these workforce will be used elsewhere, which will give you ₹150,000 revenue. And if you continue with this research project, that revenue you will not be getting. So therefore, it is ₹150,000 opportunity cost. How do you say it is opportunity cost? Whatever income that I will get because of taking up the project, I am not getting it. Therefore, it is opportunity cost. Opportunity lost is opportunity cost. By continuing the project, elsewhere sales what I would have made, I am not getting at all. Therefore, it is an opportunity cost. The next, they mentioned the accountant calculated that prime cost of the sales would be 1 lakh. So, this will be 1 lakh. Both put together is going to be 1 lakh, is what they have said. So, what are the items that you consider? Material and others and labor. And labor will be ₹40,000. Whether you engage them in this project, research project, or engage them elsewhere, you continue to pay ₹40,000. You continue to pay ₹40,000. So to that extent of ₹40,000, it is sunk cost only. But let us just have a full look at the subject matter. If prime cost is 1 lakh and 40,000 if you consider as labor, then material and other variable costs would be the remaining 60,000. This ₹60,000 I will not be incurring if I take up research project. So as far as 40,000 is concerned, it is sunk cost. Nearly and ₹60,000, you call this as opportunity gain. That ₹60,000 I am avoiding. Therefore, by taking into consideration this opportunity cost and opportunity gain, you have opportunity cost to the extent of 90,000 that you are incurring. Are you understanding, all of you? Let me repeat once again. All of you closely follow. Closely follow. If I continue with the project, I will not be getting the sales which I would be getting otherwise. By taking up this project, our prime cost will be incurred only to the extent of 40,000. If I don't take up the project, my prime cost will be 1 lakh rupees. So therefore, I have avoided ₹60,000 towards material and other costs. So therefore, it is opportunity gain there, and in other places it is opportunity cost of ₹1,50,000. And please consider that if I deduct the sales, if I deduct from sales is 1 lakh of rupees, what I would have got as contribution is rupees 50,000. Okay, so I would have got this contribution of 50,000, which I will not be getting at all. So this is not a separate item, it is only the net effect of these two. So therefore, the same 90,000, how we will be getting? So the same 90,000, alternatively, we can get that working. Alternatively, how 90,000 will be working out? So last contribution. How much was the last contribution? Last contribution being 50,000 rupees. How do we say 50,000 rupees as last contribution? You have ₹1,50,000 as loss of revenue, 1 lakh of rupees towards prime cost. If you compare these two, what you get is 50,000 as last contribution. Please understand, we have believed that labor is variable, and therefore we have considered contribution loss as 50,000. Now that we are knowledgeable that labor is no longer a variable item, in either case it is going to be 40,000 rupees. So therefore, labor is no longer a variable item. Therefore, what initially we have believed that contribution, what we have lost is 50,000 on the assumption that labor being variable, we have noted as 50,000. Now that you got the knowledge that labor is not variable, therefore, last contribution will be 50,000 plus 40,000. Therefore, you are getting 90,000 rupees. Either you can take up 1,50,000 minus 60,000 as 90,000 as opportunity cost, or the last contribution of 50,000 plus the labor cost of 40,000, which is no longer variable, because contribution to arrive at what is that formula? Selling price minus variable cost is equal to contribution. So in this variable cost, 40,000 rupees, you have believed that it is variable. So when it is no longer variable, your contribution will go up to the extent of 40,000. That is the reason why we have added. So 50,000, what you have believed initially as contribution loss, then 40,000 to arrive at 50,000, you have taken 40,000 as variable. Now that you have become knowledgeable that 40,000 is no longer variable, therefore last contribution should be up by 40,000. Therefore, you will take 90,000 as opportunity cost of engaging labor. I think the point is very clear. Next, research staff, that is working note number 5. Working note number 5, research staff in continue and drop. So 60,000 rupees, a decision has already been taken that this will be the last major piece of the research undertaken. Consequently, when work on the project ceases, the staff involved will be made redundant, and redundancy and severance pay amounting to rupees 25,000 share of there is a next item. So now research pay. There are two things that we have. So staff salary and severance pay. What do you mean by severance pay? When we don't require a workforce, you ask him to go home, but you can't be just asking to go home without any compensation. All of a sudden, a particular order had just got dropped. Those laborers who are engaged exclusively for that will become redundant. So you ask them, sir, this order has not come, which is not likely to come. So therefore, we don't require your services. So you may search job elsewhere. But until such time, you are to be compensated. Therefore, we call that as severance pay. Extra sum that we will be paid. So if I drop the proposal, severance pay will be paid now. How much is that? Severance pay will be paid 25,000 at 10. no salary will be paid. Because of the fact that you are continuing with the project, you pay them 60,000 rupees and you pay 25,000 rupees severance pay, because 1 year later they will become redundant. 1 year later there is no other project that you have. So 25,000 rupees you pay now or 25,000 rupees you pay later. So therefore 25,000 rupees in either case you will be paying, and ignoring the time value of money, you will say it is sunk. Ignoring time value, we consider this as sunk. And 60,000 rupees I am paying because of taking up the project, therefore it becomes relevant cost. Are you understanding? Then working note number 6. Then general, that is share of general building services 35,000. Continue and drop. Whether I continue or dropping, the share of building expenses will continue to be the same. So you call this as sunk cost. You call this as sunk cost. So what is relevant and what is not relevant, every bit is taken up for analysis. Now how do we make a presentation? So we will take up from the beginning. Every item we will take up. Research cost. Will working note number 1. Then so government agency, ₹3 lakhs. 3 lakhs. Working note number 2. So therefore, the total revenue is going to be 3 lakhs. So in fact, I will put it this way. Research cost will working note number 1. Then material cost 5,000 within brackets, working note number 3. Then labor 90,000, working note number 4. Research staff salaries. Research staff salaries 60,000 rupees. Working note number 5. 5 no. Then comes share of general building services. Nil. Working note number 6. So 1,45,000 is the cost. What is the net result? Result is that it is 1,55,000 rupees profit. What is the question required? Assume the estimates are accurate, advise the managing director whether the project should be allowed to proceed. You must carefully and clearly explain the reason for your treatment for each item of expenses item. So what is the result? What is the action? Accept the project. That's it. So how can I get notes for all classes for final live? You should have registered beforehand. So that I've been telling, my WhatsApp number, you register. You subscribe for our channel. This is the WhatsApp number. So please just don't keep on asking the same question. From whomsoever you are just getting the contact, you please just tell that. Okay. Now, our friend Balachandran was just asking a question. No capacity in tablet making. For what question he is asking, I do not know, but we have answered to all parts of the question. Now we will take up on to question number 4. So question number 4 is relevant costing as well as price fixation. Okay, market order is very important. I hope that all of you are very clear regarding question number 2 and question number 3. W Limited is to produce new products in short-term venture which will utilize some obsolete material and expected spare capacity. The new product will be advertised in quarter number 1 with production and sales taking place in quarter 2. No further production or sales are anticipated. Sales volume are uncertain but will to some extent be a function of sales price. The possible sales volume and advertising cost associated with each potential sales price are as follows. They are given you the sales volume and the probability advertisement cost, sales price of 25, sales volume and probability, and sales price of 40 per unit, and they are given the volume and the probability advertisement cost is also given. The resources used in the production of each unit of the product are production grade 1 and 2, 2 hours and 1 hour, material X and Y, 1 unit and 2 units, the normal cost per hour of labor, grade 1 and 2, 2 rupees and 3 rupees. However, before considering the effect of the current venture, there is expected to be 4,000 hours of idle time for each grade of labor. In quarter 2, idle time is paid at normal rates. Material X is in stock at a book value of 8 per unit, is widely used within the firm, and any usage for the purpose of this venture will require replacement cost is 9 per unit. Material Y is in obsolete stock. There are 16,000 units in stock at a book value of 3 rupees and 50 paisa per unit. Any stock not used will be disposed of at a cost to W Limited 2 rupees per unit. Further quantities of Y can be purchased for rupees 4 per unit. Variable overhead rupees 2 per direct labor hour work, fixed overhead 3 per direct labor hour work, totally fixed overhead not to alter as a result of current venture. Feedback from advertising will enable the exact demand to be determined at the end of quarter number 1 and production in quarter number 2, and production in quarter will be set to equal that demand. However, it is necessary to decide now on the selling price in order that it can be incorporated into advertisement campaign required. Calculate the expected money value of the venture at each sales price, and on the basis of this, advise W Limited of its course of action. Briefly explain why the management of W Limited might rationally reject the sales price leading to the highest expected money value and prefer one of the other sales prices. Okay. So now let us just understand that this problem can be handled with the help of Excel tool. Excel is what I want to use. A lot of computation will be involved. So before I could just work out, let me briefly tell you that the company has got 3 sales price at which the products can be sold. One is 20 rupees, and for 20 rupees the sales volume they have given as 4, 6 and 8, and sales price being 25, 4 sales volume they have given, and for 40 rupees also 3 sales volume they have given. Now, the normal tendency by going through the problem is that we simply multiply this 1000 into probability, arrive at the expected units, and take up variable cost, compare it with selling price so as to find out contribution, and multiply contribution with the expected sales volume, deduct from that fixed cost, and arrive at the profit, whichever gives us the highest profit that we will be selecting. This is what our mind will run. But actually, you can't try like that. Reason is that your variable cost is not varying in a very uniform way because of the fact that you have some excess material that you have bought, you have some idle hours of labor hours. So in the case of labor, so therefore the variable cost will be fluctuating at various volumes. So therefore, You cannot be taking up an average volume multiplied by a single variable cost, which will not be the case. Therefore, we are expected to arrive at, based on various sales levels, how many units are they about to produce, and for producing that many units, what will be the requirement of material and what will be the requirement of labor hours. Depending upon the requirement and the stock level of material, we find what rate they got to use. Similarly, for labor hours of requirement, taking into consideration the idle time of labor hours, so how much we have to pay and for how many units we don't have to pay. Therefore, our variable cost computation at various volumes will be the most challenging thing, and that is the reason as why we require Excel for this particular thing for a classroom work. Under examination condition, you don't have that choice. So I am using Excel for the purpose of reducing the clerical work, and now we will try this. Okay, mark this problem as very, very important. When you are preparing heavily, please just try at least 2-3 times before going to the examination. Now let me just share that information. Okay, so now all of you just watch out as how this computation is so crucial in finalizing our answers. So what I would do is that I will note down the volume of sales. So sales volume, I'm going to take it up. Sales volume across all the metrics I will be taking up. So 2000, 3000, 4000, 5000, 6000, 8000, 10,000 and 15,000. So people would be wondering as from where I am picking up all this. Please understand, in the table what they given for sales price, if it is 20 rupees per unit, they are given 4, 6 and 8. Then in the case of 25, they are given 2, 5, 6, 8. In the case of 40, they are given as 0, 3, 10 and 15. So all the volumes I mixed and I just put it in ascending order. The reason you will come to know a little later. Okay, so now let us just take up for material X. For material X, what is it they mentioned in the problem? 1 unit of finished goods would be requiring 1 unit of material X. So therefore, this figure will be multiplied by 1. At the rate of 1 unit. Then for material Y, where it is at the rate of 2 units. At the rate of 2 units would mean 2000 multiplied by 2. Okay, then they are given in the problem material X is in stock at a book value of 8 per unit. It is widely used within the firm and any usage of this purpose will require replacement cost at the rate of rupees 9 per unit. So when material is widely used, that means it is this material is used not only for this project, for other projects which the company is executing, they are buying. When you are holding sufficient amount of stock, when stock is drawn for these purposes, quite naturally it will result in shortage of stock, and to make up for the requirement elsewhere, the company will be buying it at 9 per unit. So the company is buying at 9 rupees for a different project is not on account of that project's mistake. It is because of this particular project that we have taken up, we have diverted the material for this contract, resulting in shortage elsewhere, which resulted in buying the material at rupees 9. So the effect of buying at a different rate, that being current replacement cost of 9, should be attributed to this particular project. Is that clear? So the other project would blame this particular project, saying that they are forced to buy at 9 rupees because of this project. So therefore, that regularly used item material gets cost is going to be 2000 into 9. This is in rupees. Is that clear? I hope that all of you are clear about this one. For material Y, which is an obsolete stock, that means some excess purchases they made long time back. 16,000 units they have in stock at a book value of 3 rupees and 50 paisa. At what price they bought is not at all material because it is sunk. So any stock not used will be disposed of at a cost of rupees, disposed of a, that is any stock will have to be disposed of at a cost of rupees 2 per unit, and further quantities of Y should be purchased at 4. That means, let me just take up material Y cost. Up to 16,000 units, you would have spent money to dispose it of. Remember that toxic item that we have taken up in the last problem. So will have to be disposed of at a cost of rupees 2. That you are avoiding. Up to how many units? 16,000 units. Up to 16,000 units, the disposal cost you are avoiding. And further items that you require, for which you got to spend 4 rupees per unit. So therefore, negative cost we will take into consideration. So 4,000 into minus 2. On what basis we are working, all of you? Up to 16,000 units in stock, our 2 rupees per unit we could have avoided by using it. So it is an opportunity gain. By using this in this project, this much of expenses you can avoid, which is an opportunity gain. In cost, we have got to put it in negative sign. That is what we have done in the last problem. Are you clear? So normally it could be a old stock, they will be keeping it, they will be selling it off at a very cheap price. That becomes an opportunity cost. In this case, these items are to be disposed of by giving money. That amount of money that you can avoid by using it in this project would mean it is an opportunity gain. So in cost, when you get a gain, you put it in negative. And here, what is that we will be doing? In this case, 20,000 would mean up to 16,000, it is going to be the same, 32,000 plus this 20,000 minus 16,000, that 4,000 alone, you will be buying it at 4 rupees. You will be buying it at 4 rupees. Now, the negative cost will be coming down because you are paying for that. Same way, in this case, this 32,000 negative plus this 30,000 minus 16,000. That extra quantity 14,000 you will be buying at the rate of rupees 4. That should be taken into consideration. Now material Y cost will be rupees 24,000 positive. Is that clear? Now it is all variable cost, but variable cost is not uniform for a particular item at various levels. That is the reason as why we can't multiply sales quantity by probability. So we are expected to find out the cost at various levels because of the relevant cost that you have, excess stock that you have, and where disposal cost you are avoiding. So we have taken up material as a whole. So I would just put it this way: total material cost. So for X plus Y we take into consideration at various levels. You find this way: material cost over. Are you understanding? Then comes labor. Then comes labor. Labor hours. Under that, grade 1 labor hours. How do we take up? For 1 unit you require 2 hours. 2000 into 2. It is grade 2 labor hours. Here how do we compute? This is volume into, in this case, 1 hour required. So these are all hours. Now, what is that they have mentioned regarding idle time? So they have mentioned, however, before considering the effect current venture, there is an expected to be 4,000 hours of idle time for each grade, is what they. What is that? Each grade is what they mentioned. Each grade. So grade number 1. Now it is labor cost. So up to 4,000 hours, we don't have to pay because already we have paid for them. That is the reason why you call them as idle time and idle hours. So that means, to this extent, 4,000 hours multiplied by 0. Multiplied by 0. Are you understanding, all of you? Now, for 6,000 hours, the rate is 2 rupees. So you can't multiply 6,000 into 2 because that 6,000 has got 4,000 idle time. So therefore, what we do is that 6,000 minus this 4,000, which I keep it out as constant, then multiply it with the rate that being 2. Let me tell you as what is that we have done. So each one of our hours that we have taken up here has got into a 4,000 idle time. So you are not paying 6,000 hours into 2. You would be paying 6,000 minus 4,000. Only for 2,000 you are paying 2 rupees. That means 4,000. In this 8,000 you have idle time of 4. So 8 minus 4 you are paying that 4. 4 into 2 8. In this 10 that 4 is there. Only for 6,000 hours you are paying 6 into 2. That is what I have done. Now in this case also 4,000 hours. 4,000 hours you are getting it out at 4,000 units. So therefore we will take up 2,000 into 0. Correct? So for the first three levels, on 4,000 hours basis, no cost. From here we will be having cost. What is the cost that you would be having? 5,000 hours minus this 4,000 multiplied by 3. Like how we have just explained the case of grade number 1, here it is in grade number 2 for a different number you are working, but working remaining the same. So now total labor cost 0 plus 0. So these are the items that you are arriving at as labor cost. Let us know about what is variable overheads and what is fixed overhead. And fixed overhead we can ignore because they say total fixed overhead not to alter as a result of current venture. We are expected to take up only for variable overheads. Okay, and I just hidden it. Variable overheads at the rate of 2 per direct labor hour. 2 per labor hour. How do we take up 2 into labor hours? You know, 4,000 plus 2,000. Labor hour would mean both grade we have to take into consideration. So that is the way we are arriving at. So now we are expected to so now let us just understand oh, see, mouse is not working here, so there is a problem here. F is missing. Right. So now I would like to take up variable cost. What is your variable cost? Total material cost plus total labor cost plus variable overheads. Correct? So now for all items of volume, we have just got the variable cost. Variable cost we have just got. Now we are expected to take up for each selling price the sales volume, variable cost from this ready reckoner, arrive at the contribution, multiply with probability, and arrive at the expected contribution, then deduct for each case the fixed cost and advertisement cost so as to find out as which one of these three will be profitable. Okay, now let us just take up that. When selling price is rupees 20 per unit, sales volume 4,000, 6,000, 8,000. Then sale value is nothing but 4,000 multiplied by 20. Now variable cost for 4,000. What is the cost? 52,000. And for for 6,000, go to that particular M, 88,000. For 8,000, it is M8, 1,24,000. If you want to just check up, you can just check up. 1,24,000 is against 8,000. Okay. What is contribution? Contribution is sales value minus variable cost. Correct? Then what is advertisement cost? Advertisement cost is because fixed cost we will not take into consideration. $20,000. Profit. Now let us take a probability. That's 0.1, 0.4, 0.5. Then the expected profit. So expected profit is 13,600 when selling price is 20. Are you clear? Next one, same format. When selling price is 25, the number of units being 2,000, 5,000, 6,000, 8,000. Sale value is 2,000 multiplied by 25. Okay. Then variable cost. Variable cost against 2,000 units. What you get is this is a number 22,000. Against 5,000 would be go to 5,000, 70,000. 6,000, go to that 6,000. If it is 8,000, we have already had one 8,000 at 1,24,000. Am I right? So 28,000, 55,000. Right. Advertisement cost is 50,000 in this case. Profit is nothing but 22,000 negative and probability being 0.1, 0.2, 0.2, and then 0.5. $14,200 is the profit there. Now let us just take up this and operate for the next volume, where the numbers are 3. 0 I cannot take up because for 0 you cannot have cost for that. So it is 3,000, 10,000, 15,000. Then selling price is 40. $3,000 into 40. What is the variable cost for 3,000? Then it is 10,000. Then it is 10,000, 1,84,000. This is going to be the next number. So control D I just put 3,34,000. If you want to just check out, we can check out 3,34,000. Okay. So sale value over variable cost over contribution is sale value minus variable cost. Then advertisement cost is 1 lakh. And probability is 0.5, 0.2, and 0.1. Again, 0 unit, what we can 0.2, that we have ignored. Sorry. Okay. So let us just check up the numbers once again. Whether we have taken up all the numbers right, we will just check up. Variable cost for 2,000 is 37,000. Let me just check up. $37,000, that's right. Into 40. Same price minus variable cost. Advertisement cost is 1 lakh. Yes, one more thing that we are going to do. I'll just tell you what is that. So the chance that it could be 0 units will be there. That we are not meaning to 40. Variable cost is 0. Contribution will be 0. But advertisement cost of 1 lakh will be there. And probability of that is 0.2. Because that also we have got to capture. No? When you keep it as 40, there will be no customer at all. So that also we should take into consideration. I've just forgotten to take up that. So now let us just look at the total profit. It is coming to 11,300. So now we have come to a conclusion now. What is the question that they asked? Please have a closer look at the question. Calculate the best expected money value of the venture at each sales price, and on the basis of this advice, its best course of action. The expected money value for all the three we have just given. Explain briefly why management of W Limited might rationally reject the sales price leading to highest expected money value and prefer one of the other sales prices. So please just understand, of the three, the best is 14,200. 14,200 is the best one. But what they say is that as a decision maker, you will not be selecting 25 rupees selling price, and people will be taking 20 rupees as a selling price. So 13,200 is better than 14,200 is a conclusion we would be making. And he himself had given the answer asking for the reason. So 13,200 is better to choose than 14,200. Don't go by monetary values alone. There is something else that you take into consideration for decision making. What is that factor which is influencing you to select the second best profit, and why is that you are not selecting the best profit? The reason is very simple. If I select 14,200 where selling price at 25, it is not that I will be getting 14,200. It is only an average computation. Either I will be getting 22,000, or I will be getting 5,000, or I will be getting 12,000, or I will be getting 26,000. There is a 10% chance that I will be getting loss. There is a 10% chance that I will be getting a loss. Whereas in this particular case, there is no chance that I will be getting lost, because all the possibilities against which when you deduct this advertisement cost, there is your constant cost. We never ended up with loss at all, and therefore we will prefer, and normally the preference will be based on expected monetary value only. So therefore we would select the selling price at the rate of rupees 20. So selecting rupees 20 as the selling price would avoid loss, but the expected profit would be marginally lower by rupees 600. So selecting 20 rupees as the price would avoid loss, but expected profit would be marginally lower. So selecting rupees 25 as the price would assume loss, but expected profit would be marginally higher by 600. Now you can easily judge whether you want marginally lower by 600 but you avoid loss, and you assume loss but the risk is 22,000 for a marginal gain of 600. Which one is better that you can easily decide? This is the basis. Are you clear? All of you? So Balachandran, your question was, when we continue, how we will save 5,000 in material? I'm not in a position to understand at all. So therefore, the time lag is putting us to a lot of difficulty. You put it in voicemail, and send it by WhatsApp. Okay. Okay. Now let us just take to the next level or the next problem. Are you clear? So first problem, simple problems we have just got. Then research problem and relevant cost, decision making, and expected monetary value. All that we have taken into consideration. Now we will take up on to question number 6. Question number 6. So today I got to complete the class sharp by 5 o'clock. I got to go out to pick my daughter. So already she had asked me to come by 4:30, where I said no. A company manufacturing agricultural machinery is faced with the possibility of a strike by its direct production workers engaged on the assembly of one of its machines. The trade union is demanding an increase of 7% backdated to the beginning of its financial year, and the company expects that if a strike does take place, it will last 4 weeks, after which the union will settle for an increase of 5% similar backdated. The machine whose production would be affected by the strike is sold to distributor at a discount of 20% from the current recommended selling price of 3,000. Estimated cost for the machine are fixed per annum, variable per machine, production 16,000 thousands, and per unit per machine 1,800. Distribution 1,000 thousands, and variable is 100 there. The next, direct labor cost comprising 40% of the variable production cost, and budgeted output is 27,500 machines in 50 weeks per annum. If the strike takes place, the company expects the following events. Maintenance staff whose wages are included in the fixed production cost would vary to carry out an overhaul of the conveyor system using 25,000 worth of material. An outside contractor at a cost of rupees 1 lakh, including materials, would otherwise undertake this overhaul. Sales of 650 machines would be lost to competition. The balance that would ordinarily have been produced during the strike period could, however, be sold, but these machines would have to be made up in overtime working, which would be at an efficiency rate of 90% of normal. This would entail additional fixed cost of rupees 10,000 and wage payment at time and 1.5. You are required to state with explanation and full supporting data whether from a purely economic point of view you would advise the management to allow the strike to go ahead rather than agree to the union's demand. B. Assume that the strike goes ahead, that it lasts 3 weeks, after which agreement is reached between the company and the union for 6% pay increase backdated to 1st January. Assume all that the anticipated loss of sales to competitors of 650 machines occur and overtime working makes up the balance. A newspaper report reports that the cost of the strike to the company was 5 million. The trade union counters this claim by insisting that company to its benefit contribute the strike as the machines are selling across. You are required to comment on the statement made by the press and the trade union. State with supporting calculation whether the company was justified in using overtime working to produce the balance machine saleable, but not produced during the strike. This is what they have given. Now, Let us just understand what basically had happened. A company has got a manufacturing operation of a machinery used in agricultural activity. It is not company which is going in for a strike. I mean, the entire labor force is not going for strike. That particular division, they are going in for a strike. Or the management is expecting as whether they can allow the strike to go ahead or avoid strike. So trade union is demanding 7% backdated from the beginning of the financial year, and the company expects if strike is allowed, it will lose, that is, there will be a loss of production for 4 weeks. But since they have gone in for strike which caused damage to the company, they may not accept what the trade union is demanding, and therefore they will accept 5% only. So they are asking us to try purely from economic point of view, not egoistic. Purely from economic point of view, we are expected to take it up. Then the machine whose production is affected by the strike, that is, those items which are produced as of now, where we are talking about the strike and all that, this particular division, their selling price, the list price is 3,000, and they don't sell directly to customers, they sell to distributors. To them, they offer at 20% of the list price. That means customer who wanting to buy, they will be buying it from the distributor at the listed price. To the distributor, we offer at 80% of the listed price, and therefore, if the distributor sells at 100 rupees, he will make 20 rupees profit there. And for us, the price is not 100, for us, the price is going to be 80. This English is going to cause some amount of worry. People might misunderstand that because of the strike, we are selling it at discount. It's not like that. We are selling to the distributors normally at a discount of 20%. This is what you, even the authors of the book, what they do is that they sell to the bookshop owners. That is, I mean, the publisher sell not at the list price. They give it at 40% discount. If it is 100 rupees, they offer it at 60 rupees to all these book shop owners. The book vendors, to them, they will be selling it at 60 rupees. And the student who goes there and is asking for some discount, okay, 10% you take. Whose price? It is the publisher who had fixed the price at 100. The student will be feeling happy, okay, 90 rupees at least you got, whereas the price is 90. Whereas the price is 100, you will get it at 90. But please understand, the shop owner is getting 30 rupees, whereas the publisher is getting 60 rupees as a selling price, not profit. In that, he has got cost, royalty, etc. He has got to fix, he has to pay. So that sort of business only they are talking about. Don't get the impression because of the strike only they are offering it at discount. So offering at 20% discount is the normal commercial practice that they are following. So therefore, do not connect this strike with discount. If the strike is over, it is not that they are selling it at 3,000. It's not like that. The customary practice is that they sell at 80% of the price. So I will put it this way: the selling price is going to be 3,000 into 80%. To the dealer, we will be selling it at 2,400. This is the selling price. 3,000 is the list price. Okay. Then variable production cost. Under that, they say 40% of the variable production cost. 40% of the variable production cost is for labor. So 60% is for others, materials and others. 1,800 into 60%. It is 1,080. Labor 1,800 into 40%. 720. Then variable distribution will be 100. This is for the existing one, 1900. Contribution 500. This is the basic structure. Units 27,500. Contribution 27,500 into 500. That should give you 137 lakhs and 50,000. Then the fixed cost is 170 lakhs and their profit was in the negative. It was in the red. $32 lakhs and 50,000 is the loss. This is the loss. This is the scenario. These are all before strike. This is before strike. Okay. Now, so I will put it this way: no strike and strike. That working is only a basic working that we have just drawn. So there are two scenarios that you are having. One is no strike, the other one is strike. Production, when there is no strike, it is 27,500. What they given? When you have a strike, what is happening? Let us just have a look at. They mentioned 4 weeks gone. How many weeks computation that we are going to take up? 50 working weeks they have mentioned. So in this case, 27,500 divided by 50 multiplied by 46. Why 46? 4 weeks of strike plus it is not that whatever sales that they have not made, they are just allowing it to go like that. They mentioned that sale of 650 units would be lost to competition. The balance they could produce during overtime. So therefore, it is a very simple computation only. 27,500 minus 650. They have lost 650. They have lost 650. So 27,500 minus 650. It is 26,850 units you have sold. That's it. How much of that under overtime, that we will see later. Correct. Our selling price were never compromised. 2,400 in either case. Okay. Then variable production. Variable production, material and others. 1,080. From here we have picked. From here we have picked. for labor, if no strike would mean whatever demand they are making 7% we are accepting. So it is 720 multiplied by 107%. It is 770.40. This is for all the units from the first day onwards we have got to take up. The other one is that 720 multiplied by 105%. 756. Correct. Then variable distribution 100. Right. Then if the strike takes place, maintenance staff whose wages are included in fixed production cost would be used to carry out an overhaul of the conveyor system using 25,000 rupees of material. That we will take it up later. One 1950.40, 1936. Am I right? Okay. So contribution 464, 2400 minus 1950.4, 449.60. Now we will get the contribution. So 449.6 into 27,500. This 123 lakhs and 64,000. 464 into 26,800. 26,850, sorry. It is 124,58,400. Correct. Now overhaul cost when there is no strike, you incur 1 lakh of rupees. Here you incur 25,000 only. Are you clear? That is what they are maintained. There is a mention. Maintenance staff whose wages are included in fixed production would be used to carry out overhaul of the conveyor system using 25,000 rupees worth. An outsider when there is no strike. Okay. Then some overtime premium they are talking about. Overtime premium is going to be nil because there is no strike at all. So what is that they mentioned regarding overtime premium? Sales of 650 units would be lost. The balance would be ordinarily being done during the strike period. However, but these machines would have been made during overtime, which would be at an efficiency rate of 90% of normal. They are paid at time and 1.5, and there is an additional fixed cost. So some additional fixed cost they are talking about, that is nil, and that is going to be 10,000. So overtime premium is there, then loss of efficiency also there. So we will just take up each one of those cases. So now for this purpose, I am going back here. So this is working note number 1, working note number 2. I am going back here. So units affected by strike. It is 27,500 divided by 50 multiplied by 4 because the strike period is for 4 weeks. So it is 27,500 is for 50 weeks multiplied by 4, that should give you 2,200. So lost sales, that is we have lost the sales. How much ever you just do, so customer on seeing that we are not having the product is going to another brand. You can't be just telling I will be giving it 1 month later and all that. He is not interested to wait, and 650 gone. So therefore, done by overtime 1550. 1550 is the number of units that were carried out on overtime period. So what is the overtime premium? Overtime premium is, there is wage payment is time and 1.5. That is normal payment is there in 100. That extra is only half, 50%. So what is the wage packet? 756. So overtime premium is 50% of 756. 756 into 0.5. It is 378. Is that right? So normal wages 1.5 times they have mentioned. Premium is not 1.5 times. Wage payment is at 1.5 times. So the normal rate we have captured. Where is that we have captured? We have captured 956 into 26,850, which is inclusive of products that we have done through overtime. So this is basic rate we have taken up. Only that extra 50% we have taken up. So this is per unit. So overtime premium is 1,550 into 378. That comes to 5,85,900. Lakh 85,900. This additional 10,000 also to be taken up. Then there is a efficiency loss that they have. What is that efficiency loss? So when the working hours are little longer, the efficiency level is dropping. You would have just seen even in our class also more than 3 hours would mean people will be just going out. They want break. I am not giving break because the discussion is so intense that the break sometimes will dilute our concentration. Loss of efficiency 90%. How do we take up this loss of efficiency in the computation? Working note number 3. That is the pay that you make for overtime. When you effect the payment, the work is only 90% over. So what is that then we should do? So we have to take extra time to complete. That extra time that we are taking because of the loss of efficiency is the cost that we are going to take. Let me repeat. The normal time, the speed at which we do the job, for which computation we have taken up. But with that time and the rate, we could just see only 90% of the work got over. Then the remaining 10% you got to complete by taking extra hours. That extra hours taken is an amount of cost. That is what we will be taking up now. So 1,550 units. 1,550 units done under overtime into the rate of pay is 756 normal rate into 150%. Now, this is the rate at which they are paid. 550 units into 756. 756 is 5% increase in the rate. 150% is the normal pay plus overtime pay. This resulted in 90% of the work over, and we are expected to operate only for the 10%, because with this amount we have completed only 90%. So I will explain the logic, please just don't worry. 1550 multiplied by 756 into 1.5 divided by 0.9 into 0.1. That comes to 1,95,300. Negative. 1,95,300. So now let me just convey the logic. It is a very simple logic only. So number of units 1550. Rate of pay normal 756. So normal overtime with premium 756 into 1.5, that should give you 1134 rupees. So what will be the direct labor for this 1134 into 1550? 17,57,700. This will result in 90% of the work over. Because you are doing it under overtime, the stress is more, the concentration level is down. What will be the direct labor cost at 100% completion? So it will be 17,57,700 divided by 90 multiplied by 100. 19,53,000. Correct? What is the extra direct labor cost? 1,95,300. That is the one that we have directly found out. Okay. Now all items we have taken into consideration. Now we have to find out what is the profit. So in both the cases, we can take up fixed cost also. Since fixed cost is going to be common for both, no. So I have not taken into consideration. Anyway, we will just do that. 170 lakhs. What is the profit? So by not deducting it, people will be asking the questions, and why is that you have ignored it? I am going to deduct same amount, so therefore deducting or not deducting is going to have any, we will not be having any impact at all. Minus 1 lakh minus 170 lakhs. This should give you 47 lakhs and 36,000 negative profit. Here 124,58,400 minus 25,000 minus 585,900 minus 10,000 minus 1,95,200 minus 170 lakhs. This should give you 53 lakhs 57,800 negative. So therefore, you are expected to know what is the benefit that we derive. There is cost of strike is 6,21,800. By allowing the strike to go, the company is losing additionally 6,21,800. That is a question. Purely from the economic point of view, if you allow them to go for a strike, what is the cost? Cost is 6,21,800. Is that clear? Now, this is only the first part. I think after doing the second part, I may have to leave. So my daughter is just telling that nobody is there in the office, so come here. Okay. So B part, assuming that strike goes ahead, and that is that its last 3 weeks, after which agreement is reached between the company and the union for 6% pay increase backdated to 1st January. Assume also that anticipated loss of sale to competitors being 640 occurs and overtime working up for the balance. The newspaper report that the cost of the strike is 5 million trade union counters. So here the question is that you are required to comment on the statement made by the press and the trade union. Both of them are not correct. State with supporting calculation whether the company was justified in using overtime to produce the balance of the machine saleable but not produced during the strike. Whether overtime is to be taken up or not. Here the data size is not the same. So please understand the strike period is not for 4 weeks. The strike period is reduced to 3 weeks. And the rate of the increased pay is 6%. So therefore there will be a lot of change to that. So now the question is that whether it is beneficial to carry out under overtime or no overtime. So therefore we will take it up no overtime and you work out as overtime. So matter becomes easier. So production, when there is no overtime, you produce all 27,500. No. When there is no overtime, 3 weeks loss will be there. 27,500 divided by 50 into 47. $25,850. That means 3 weeks. 3 weeks of sales lost. That's it. You don't take any effort to retain the customer. Is it clear? In this particular case, when overtime is there, in 27,500, what you lose is only 650. It is 26,850. Are you understanding? 25,850 when there is no production, when there is no overtime, you produce only for 47 weeks and work out. In this case, you work overtime and make up the lost production, but 650 you cannot just make it up. Selling price 2,400 in both the cases. Variable production, material and others 1,080. Labor, it is 720 into 106%. 7632, 763.2. Then variable distribution. Variable distribution, I think it is 100, no? 100. $1080 plus 763.2 plus 100. 1943.20. 1080 plus. It is going to be same only. Check. Contribution per unit. $2,400 minus 1943.2. 456.80. contribution 456.80 multiplied by 25,850. 25,850. 25,850 multiplied by 456.8. That comes to 180,08280. 456.8 multiplied by 26,850. 122,65,080. Correct? So please just understand from the past what and all we can ignore. This overhaul we will ignore because overhaul was carried out during the period of strike. Whereas we are discussing about whether we can work during the post-strike period under overtime or not. So therefore, this will not influence us at all. So therefore, we will ignore. We will ignore what? This overhaul. Or if you feel like that, you can take it up. You can say that it is 25,000 rupees in both cases. Because both suffered strike. So it is all the question as whether you can take up the loss of production under overtime or not. In both the cases, we had the overall cost of 25,000. That is the reason as why I told you it is not required. This sum cost. Correct? It is not about 1,25,000. In this case, no strike and strike. In this case, in both the cases, what we are trying out, strike was there. Whether we can manufacture during a post-strike period under overtime or no overtime. So please be careful. Our title also was correct that way. No overtime and overtime. It is not the question of no strike or no, there is strike. But anyway, we have just taken up. Overhaul we have taken up. Overtime premium. So in this case, no overtime, so no overtime premium. Then additional administration expenses nil. Loss of efficiency because you are not done under overtime, so it is nil. Then fixed cost. Now we have got to fill additional administration cost is going to be 10,000. Overtime premium. So now we need to know how many items are covered under overtime. Working note number 4. 27,500 divided by 50 multiplied by 3. It is not 4 weeks, it is 3 weeks. 27,500 divided by 50 multiplied by 3. 1650. Lost sales 650. So overtime production is only for 1,000 units. Overtime production is for 1,000 units. Then what is the rate of pay? 763.2. So direct labor 763.2. Overtime premium is 50% on that. 763.2 into 0.5. 381.60. So per unit. So overtime premium is going to be 381.60 into 1000. 3,81,600. 3,81,600. For a similar scenario, in the previous case, it was 585,900 because we were producing greater number of units. Here, lesser number of units, so therefore 381,600. So loss of efficiency that we are going to take up. Working note number 5. Loss of efficiency. So 1000 units multiplied by 763.20 into 150 percentage divided by 90 percentage into 10 percentage. Already I have explained 1000 units, 763 is a new rate, 150 is the total rate for overtime production, and this could achieve only 90 percentage, and 10 percentage is our loss of efficiency. Now let us just work out that. 1000 multiplied by 763.2 into 150 percentage divided by 0.9 into 0.1. That should give you 1,27,200. 1,27,200. There are shortcut methods that we have, but since we have done the last problem like that, we have continued like in this manner only. So it is 118,08280 minus 25,000 minus 170 lakhs. That should give you 52 lakhs 16,720 negative. Here 122,65,080 minus 25,000 minus 381,600 minus 10,000 minus 127,200 minus 170 lakhs. This should give you 52 lakhs 78,720 plus 52,16,720. So 62,000 rupees extra loss. Extra loss. Is that clear? So therefore, it is better that we don't do overtime. So shortcut way also we do have, but this will enable you to understand it much better. One moment. Okay. We will continue for up to 5 o'clock because she said she will wait until 5 o'clock. Are you clear? One moment. I may have to go now. She is asking me to come there by 4:45. Now it is 4:35. So we will just limit this class at this moment, and I thought we will start with standard costing, and tomorrow we will be taking up onto transfer pricing. Then following class we will be taking up with standard costing. Okay. Thank you.